Silver just crossed into the kind of territory where the market can pretend it's just another rally anymore. Because once the mid-80s are on the screen, every weak hand, every overleveraged short, and every complacent hedger is forced to make a decision in real time. And the moment it tried to flirt with 86 at the open, you could feel the conflict. One side wants to frame this as a simple safe haven headline, and the other side is staring at the plumbing, because the plumbing is where price stops being a story and starts being math. Stay with me, because by the end you'll know the one level that matters this week, what kind of pullback is actually bullish. What kind of pullback is a trap and the quiet signal that tells you whether physical demand is real, or just a loud excuse for a positioning unwind. Here's the uncomfortable part. When silver moves like this, people rush to explain it with emotions. Fear, chaos, geopolitics, central banks, a weaker dollar. And yes, those are accelerants. But accelerants don't create the fire by themselves. The fire starts when the market structure gets stressed, when inventories aren't where they need to be, when the curve starts behaving oddly, when spreads start telling you a different truth than the headline price. And that's where the real pressure starts. Because the hidden detail in silver is never, does silver exist? Silver exists. The hidden detail is whether silver is in the right place, in the right form, at the right time, for the specific obligations the market has created. That sounds like a small distinction. It's not. It's the difference between a calm market and a market that snaps. If you remember only one thing from this video, remember this. The market can tolerate scarcity. It panics when scarcity becomes deliverability. When deliverability becomes a question, paper claims stop feeling interchangeable with metal. And when paper claims stop feeling interchangeable with metal, the price can gap in a way that looks irrational if you are only watching the spot chart. But it isn't irrational, it's forced behavior. Now, let us talk about what people mean when they say physical demand spikes at the open, because this is where retail investors get misled. A physical spike doesn't mean a line at a coin shop at 9 a.m. A physical spike is a sudden urgent bid for immediate metal that ripples through the system. Refiners and fabricators needing feedstock, wholesalers pulling forward orders, dealers widening premiums because inventory is thin, and this is the key, hedgers and market makers rushing into futures and options to manage exposure as they get pulled towards spot. And if this one detail shifts, the whole setup changes. That's why 86 matters even if you never get a perfect print there. In the current tape, 86 is not a target. It's a trigger zone. Round numbers and recent high zones are where the market's hidden wiring is exposed. Stop orders cluster. Volatility targeting funds adjust. Dealers who sold options have to hedge differently. Margin requirements start biting. Liquidity thins. And the next detail is what flips the whole setup. You can get the same headline price with totally different risk under the surface, depending on how the curve and the inventory situation look. So let's anchor reality first. Over the last couple of weeks, silver has been ripping around like something has shifted under the floorboards. Early January prints in the low 70s quickly escalated into the high 70s, then the low 80s, and then, right as the market is trying to catch its breath, you see a fresh surge that puts record highs on the board with reports of silver pushing into the mid-80s, while gold is also screaming higher. That's not a slow grind. That's a regime change. And in a regime change, your job is not to argue with the move. Your job is to understand what the move forces other participants to do. Because what it forces them to do is what sustains it. Start with the calendar, because the calendar is the catalyst that traders love to ignore until it hits them in the face. January is when silver stops being a chart and becomes a delivery schedule. Futures aren't just prices. Futures are obligations timed on a calendar. There are notice days, delivery windows, roll periods, expiration dynamics, and the subtle but brutal truth that someone, somewhere, has to decide whether they're taking delivery, making delivery, or getting out of the way. And when you're near those windows, thin liquidity can turn normal buying into a spike that looks like a shock. This is why the open matters. The open is often where liquidity is thinnest relative to urgency. Overnight news hits, risk managers reset, funds rebalance, dealers rehedge. Spreads reprice. And if there's any physical tightness, it expresses itself first when the market has the least ability to absorb it. But that's not the part that matters. The part that matters is what the market does after the spike. Does it hold gains without giving them back easily? Does the curve stay firm in the front? Do nearby contracts remain stubborn? Do premiums stay elevated? Do dips get bought fast enough that bears can't breathe? Because if those things persist, the shock wasn't a one-off, it was a signal. Now let's get surgical on the hidden detail. Inventories. Every time a silver squeeze narrative goes viral, people start shouting, look at the inventory numbers, and then they stop thinking. Because inventory is not one number. Inventory is categories. Inventory is ownership. Inventory is deliverability. In the futures world, especially in U.S. exchange-related vault reporting, the headline that matters is not how much metal is in the building. It's how much metal is registered and available to be delivered against contracts. They're S metal that is eligible, meaning it meets specs and is stored there, but it's just not necessarily available for delivery because it belongs to someone who hasn't committed it. There's metal that is registered, meaning it's specifically earmarked as deliverable. In a calm market, people treat those categories like they can shift smoothly. In a stressed market, that shift is the bottleneck, and that's where the real pressure starts. Because if deliverable supply feels tight, shorts face a choice. They can roll, buy back the nearby and sell a deferred. If the curve allows it, they can try to source physical metal and deliver, or they can cover outright and accept the loss. Each choice has a cost, and when the market senses that the cost is rising, price can move fast. This is also where the paper versus physical conversation gets real without turning into a cartoon conspiracy. You don't need to believe in a shadowy cabal to understand incentives. Market makers sell liquidity, funds chase momentum, producers hedge forward, banks run books designed for stability, and all of them manage risk using models that assume markets are generally liquid. When liquidity thins and deliverability becomes uncertain, those models don't just get stressed, they force action. Forced action is what creates outsized moves. Now, a lot of people will ask, if physical is so tight, why do we see big vault numbers in places like London? Good question, and it's exactly why this story confuses smart skeptics. London can report enormous holdings and the market can still feel tight, because vaulted doesn't mean available. Metal in London is often held for ETFs, allocated accounts, institutional custody, and it can be encumbered by leases, swaps, or internal balance sheet needs. It's a warehouse of wealth, not a supermarket shelf. And here's the subtle kicker. Even if the total pile grows, that doesn't guarantee it's in the right form to satisfy specific delivery demands elsewhere, on time, without friction. That's the hidden detail again: location, form, and timing. This is why geographic fragmentation matters. Metal can be in one vault system, while the pressure is in another. It can be in the wrong bar form for a particular delivery requirement. It can be committed to someone else, and moving it isn't instantaneous. Refining, assaying, transport, insurance, paperwork, and time all matter. And the next detail is what flips the whole setup. When policy uncertainty or trade friction changes incentives, metal tends to get stuck where it feels safest, not where it would normally flow. That reduces float, and float is what keeps markets calm. So now tie that back to the price. If silver is printing record highs in the mid-80s and threatening 86, it's telling you something about urgency. You can't have that kind of move on a sleepy, well-supplied curve without something forcing hands. Sure, you can have speculative momentum, but speculative momentum by itself usually fades quickly when the market hikes margins or when liquidity returns, unless physical tightness and structural demand keep the floor bid. And that's where the real pressure starts. Let's talk spreads, because this is where the truth leaks out. People obsess over spot. Professionals watch the curve. Is the front month unusually strong relative to later months? Do you see a curve that looks like it SS trying to go backward A-aided, meaning the nearby is more expensive than the deferred, because immediate metal is valued more than future promises? In precious metals, a persistent signal of nearby strength can be the market's way of pricing urgency. It doesn't have to be extreme. It just has to be stubborn. And if it is stubborn, it tells you that rolling shorts are paying a tax, and that tax is fuel. And if you're in the metals crowd, you already know the psychology here. Silver is infamous for whipsaw. It punishes impatience. It punishes leverage. It punishes certainty. Which brings us to the most under-discussed weapon in this market: margin and volatility policy. When exchanges raise margins, it's framed as stability. Mechanically, it's a liquidity drain. If initial and maintenance margins go up, leveraged participants have to post more collateral. Some can, some can't. Those who can't are forced to reduce positions. And forced reduction can look like a sudden dump, even if the broader trend is intact. That's why you can see a brutal flash down in the middle of a bullish setup. It's not a contradiction. It's how risk gets managed. And that's how the market will try to manipulate you emotionally, even without anyone rigging anything. Volatility spikes will be used to shake you out. Headline whiplash will be used to make you question the thesis. A vicious downtick will be used to convince you the top is in right before the next leg up. And that's where the real pressure starts. Not on your portfolio, but on your nervous system. So you need a shield. The shield is knowing the difference between noise and structural signal. Noise is a fast move that doesn't change the curve, doesn't change the behavior of dips, doesn't change the way the market reacts to key levels. Structural signal is when the market refuses to give back key zones, when buyers step in earlier and earlier, when the curve holds firm, when physical availability anecdotes become consistent, and when macro continues to lean in the same direction. Now, let's bring in macro, because macro is the accelerator that keeps this from cooling off quickly. When gold is breaking above new milestones and silver is tagging record highs in sympathy, it tells you the market is pricing instability. A weaker dollar increases the purchasing power of non-US buyers. Rate cut expectations or rate uncertainty make non-yielding assets more attractive. Geopolitical tension raises the bid for insurance assets. But here's the nuance. Macro isn't why silver moves first. Macro is why silver doesn't get relief when it moves. In other words, in a calm macro, a spike can mean revert. In a stressed macro, a spike can mean the market is repricing an entire regime. The next detail is what flips the whole setup. In a regime shift, the default assumption changes from sell the spike to buy the dip, and that alone rewires flows. Now stack in supply chain reality, because this is where skeptics either get convinced or they walk away. Silver supply doesn't respond like oil. You can't just open a valve. A meaningful share of silver production is a byproduct of mining for other metals. That means silver supply is partly a passenger to the economics of copper, lead, zinc, and gold. Even if silver price screams higher, it doesn't instantly create new primary supply. And even the supply that does exist still has to go through refining, transportation, and allocation decisions that have lead times. This matters because demand can surge faster than supply can respond. And in those windows, price doesn't negotiate gently, it jumps. Now, layer industrial demand. Silver isn't just a shiny thing you stack, it's an industrial metal with deep roots in technology, electrification, and manufacturing. That means you get a demand profile that can be sticky. If manufacturers need silver for production, they can't just wait for the dip the way a speculative investor might. They hedge, they procure, they lock in. And that industrial bid can quietly tighten the market in a way that only shows up when something else hits, like geopolitical fear or a currency move, at which point price leaps and everyone pretends it was obvious. Now we're ready to talk about physical demand spikes at the open again, because by now you should hear that phrase differently. If the open shows an aggressive push and then the market holds above key reference levels, it suggests the bid isn't purely speculative. It suggests there's a pipeline behind it. It suggests the market is trying to price immediate availability, not just future expectations. And that's where the real pressure starts. But let's be honest, there are counterpoints. And if you ignore counterpoints, you lose trust and you lose money. So here are the big uncertainties you should keep in your head at the same time. First, a lot of the recent verticality can be positioning and reflexivity. When silver breaks out, trend followers pile in. Dealers who sold calls hedge by buying futures as price rises. That hedging can create a feedback loop. Price up, hedging up, price up more. It feels like a supply squeeze even when it's partly a derivatives loop. Second, margin policy can produce violent pullbacks that look like thesis failure but are actually leverage flushing. Third, if the macro driver, dollar weakness, rate expectations, geopolitical stress, cools suddenly, metals can get hit hard even if physical remains tight, because financial flows dominate in the short term. Those are real risks, and they lead us to the two-scenario lens you need right now, because without this lens, you'll either panic sell the right idea or chase the wrong moment. Scenario one is the controlled pullback and retest. In this scenario, after a mid-80s surge, silver pulls back toward a key zone. Think the low to mid-80s, back into high 70s or around the last breakout area, on heavy headlines and scary candles, and everyone declares it over. But then it stabilizes. It holds above a prior resistance that becomes support. Dips start getting bought faster. The curve stays relatively firm. The market shows you that sellers can't push it down without immediate demand showing up. That's bullish. That's a reload. That's the kind of pullback that sets up the next push because it resets leverage and creates a cleaner base. Scenario two is the continuation squeeze. In this scenario, there is no comfortable dip. The market stays bid, gaps happen at the open, and every minor pullback gets bought almost immediately. That ends when the risk shifts from, will this hold support, to, how far can this run before volatility policy intervenes? In a continuation squeeze, you don't get to be calm. You get to be prepared, because squeeze behavior creates gap risk both ways. Up gaps that leave you behind, and down gaps that punish leverage. Now, what tells you which scenario you're in this week? Not vibes, not tweets, not the loudest headline. It's behavior. If silver is making new highs and the market is refusing to give back key levels, watch whether the front end of the curve stays stubborn. Watch whether the market reacts to margin or volatility policy, with a brief flush and then a fast reclaim. Watch whether physical anecdotes, premiums, delivery times, availability remain tight rather than easing. Watch whether the dollar and rates keep the wind at metals back. And watch whether the market keeps treating certain levels like magnets. Let's talk levels, because you need a map, not a prophecy. In a tape like this, the most important levels are not complicated. They're the ones everyone sees and the ones everyone is forced to respect. The mid-80s zone is one. It's the psychological frontier. A clean hold above it changes sentiment from this is a spike to this is the new range. Oh, the 86 area is another, not because it's mystical, but because it's the point where the market's short-term memory shifts. Above that, you have price discovery. Below that, you have a fight. Then you have the prior breakout and consolidation zones in the high 70s and low 80s. Those are your sanity checks. If the market pulls back into those zones and holds, it's telling you demand is real. If it slices through them and can't reclaim them quickly, it's telling you the move was more fragile than it looked. And that's where the real pressure starts. Because at those levels, participants can't stay neutral. Funds rebalance, dealers adjust hedges, producers reconsider hedging ratios, shorts reassess survival, and retail gets emotionally tested. Now, let S bring in one more proof layer that skeptics appreciate. The concept of deliverable versus non-deliverable isn't just a US vault accounting issue. It's a global reality. Even if London vault holdings rise, and even if global above-ground stocks are large, the marginal bar, the bar that can actually satisfy the next obligation without friction, is what sets price at the margin. Markets price the marginal unit. If the marginal unit is scarce or slow to move, price can overshoot. That's not conspiracy, that's economics. And if you want to understand why the market can overshoot to levels that seem insane, consider the reflexivity of shorts and margins. A short position can be rational in a calm market. It becomes existential in a runaway market. Rising prices increase margin requirements. Increasing margin requirements force collateral posting. Forced collateral posting causes liquidation elsewhere. Liquidation elsewhere can create cross-market stress. Cross-market stress can reduce liquidity further. And reduced liquidity can make the same amount of buying push price more. It's a spiral. And the next detail is what flips the whole setup. When volatility rises, the very funds designed to stabilize portfolios, risk parity, volatility targeting, CTA trend systems, can become pro-cyclical, selling what falls and buying what rises, amplifying the move. So if you're watching this as a retail investor with a macro brain and a healthy skepticism of institutions, here's the most finance credible way to think about it. Don't argue about whether they are suppressing it. Look at incentives. Look at constraints. Look at where stress accumulates. If physical demand is rising, stress accumulates in immediate availability and spreads. If derivatives positioning is stretched, stress accumulates in gamma and dealer hedging. If macro is unstable, stress accumulates in currency and rates, keeping the bid under metals. If policy uncertainty increases, stress accumulates in geography, as metal gets parked where it feels safest, reducing float. Those are mechanisms. Mechanisms are tradable. Narratives are entertainment. Now, let's zoom into what you should watch in the next week or two, because this is where most videos get sloppy. You don't need 100 indicators. You need a handful that actually map to the thesis. First, watch how the market behaves around the open. Not because the open is magic, but because the open is where liquidity meets urgency. If you keep seeing sharp pushes at the open and the market holds the gains, it suggests demand is persistent and sellers are thin. If you see open spikes that fade hard and don't recover, it suggests liquidity is being used to distribute into strength. Second, watch the curve. If the nearby contract stays unusually firm relative to deferred months, it suggests near-term tightness. If the curve relaxes and deferred months stop following, it suggests the market is pricing the move as temporary. Third, watch volatility policy and margin chatter. If margin hikes trigger a sharp flush but the market reclaims quickly, that's bullish, because it means leverage is being cleared without breaking structure. If margin pressure triggers a cascade that breaks key support and can't reclaim, that's a different game. Fourth, watch physical signals in your own world. Are premiums widening? Are delivery times extending? Are dealers limiting sizes? Don't treat one anecdote as gospel. Look for a pattern. Patterns are what matter. Fifth, watch the macro impulse. If the dollar keeps weakening and rate expectations stay supportive, that's fuel. If the macro impulse flips suddenly, strong dollar, risk and surge, abrupt easing of geopolitical stress, metals can get hit hard even in a tight physical market because financial flows can dominate in the short run. And here's the micro cliffhanger that matters. If one specific level breaks cleanly, the math changes because it changes what participants are forced to do. That level is the one that defines whether this mid-80s surge becomes a new floor or a rejected peak. If silver can hold and build above the mid-80s zone without collapsing back into the prior range, it forces a new round of hedging and positioning adjustment. It forces shorts to accept that the tape is in price discovery. It forces anyone underallocated to chase or wait for a dip that might not come. But if the market fails hard and loses the prior breakout zones in the low 80s and high 70s and can T reclaim, it tells you the move was more financial froth than structural repricing. Now, none of this is a promise, and I'm not here to sell you a fantasy of guaranteed returns. Silver can whip around violently even if the thesis is correct. In fact, the more correct the thesis is about tightness and stress, the more violent the tape tends to get, because stress expresses itself through discontinuity. That's why your risk framing matters more than your conviction. So what's the sane approach? It's to separate time horizons. Short-term traders need to respect volatility and levels and accept that the open can gap. Medium-term investors need to focus on whether the structure holds and whether the mechanisms, deliverability, curve behavior, macro support, and physical signals remain intact. Long-term holders need to be honest about their tolerance for drawdowns and not confuse "I believe in the thesis" with "I can handle a 30% swing without doing something stupid." And if you're wondering what invalidates the whole story, it's not a single red candle. It's a shift in the underlying pressures. If spreads normalize, if nearby tightness relaxes, if physical anecdotes ease broadly, if macro turns sharply against metals, if supply responds faster than expected. Those are invalidation signals. One scary day is not. Now let's return to the title, because the phrase $86 silver shock is a perfect test of your psychology. The market loves round numbers because humans love round numbers. 86 feels like a headline. It feels like a milestone. And milestones do two things. They attract momentum buying and they attract profit taking. That's why the first test of a new milestone is often chaotic. The second test is where the truth shows up. The third test is where the move either breaks free or fails. And that's where the real pressure starts. If we do get that clean push and hold above that zone, what happens next is not mysterious. It's mechanical. Price discovery attracts trend. Trend attracts hedging. Hedging attracts more buying when dealers are short calls. Shorts feel pain. Pain creates covering. Covering creates more price. At the same time, anyone who needs silver for industrial reasons has to decide whether to chase or risk supply disruption. That combination is how you get a move that keeps going even when it feels too far. Oh, but if instead we get the classic silver playbook, spike, margin shock, dump, panic, then slow grind back up, your job is to not get emotionally inverted. The market will try to make you buy high and sell low by making volatility feel like information. Volatility is not always information. Sometimes it's just the cost of a repricing. Here's a quick way to keep your brain from being hijacked. When you feel the urge to act, ask, did something structural change? Or did the market simply move? If it simply moved, you don't need to react the way your emotions want you to. If something structural changed, curve behavior, key level breaks with follow through, macro regime shift, then you adjust. But you adjust with a plan, not with panic. And speaking of plans, here's the near-term roadmap in plain language. If we see a controlled pullback, the best case bullish behavior is a pullback that holds above the prior breakout zones, stabilizes, and then reclaims momentum without requiring a miracle. You want to see buyers show up before fear becomes consensus. You want to see the market respect support, not just bounce randomly. If we see continuation squeeze behavior, you want to avoid thinking you can outsmart every wiggle. In squeeze conditions, trying to trade every micro move can be a donation. The key is recognizing that squeeze behavior increases gap risk and makes stops vulnerable. Risk management matters more than being right. And if the market does something ugly, like a sudden sharp breakdown that slices through the key zones and stays below them, then you don't rationalize. You accept that the setup changed. You wait for structure to rebuild, you protect capital. Because pride is expensive in silver. Now, I want to address the institutional skepticism directly, because I know many of you carry it for a reason. Institutions have incentives, they manage narratives, they manage risk, they prefer stability. But you don't need to accuse anyone of wrongdoing to recognize that when a market threatens to become disorderly, every major participant tries to reduce disorder. That can mean margin hikes, it can mean liquidity provision changes, it can mean positioning adjustments that look like suppression to outsiders. It can also mean a scramble for physical that looks like a squeeze to insiders. The reality is often more boring and more brutal. It's risk management under pressure. And the most important thing to remember is that risk management can create opportunity for those who understand it. When margins rise, weak hands are forced out. When weak hands are forced out, structure can reset. When structure resets while underlying demand remains, the next leg can be cleaner and faster. But that's only true if the underlying demand remains. And that's why you watch the curve, the calendar, and the physical signals, not just the headline price. So where does that leave you? Right now, today, this week? It leaves you with a simple thesis and a disciplined checklist. The thesis is that silver is not merely reacting to headlines. It is repricing under a mix of macro instability and market structure stress, where deliverability and immediacy matter more than comfortable narratives. The checklist is whether the market continues to behave like that is true, stubborn nearby strength, resilient reclaim behavior after volatility shocks, persistent physical tightness signals, and macro tailwinds that don't reverse quickly. If those things stay true, then the mid-80s surge and that 86 tripwire aren't a one-time spectacle. They're a sign that the market is trying to establish a new range at higher altitude. And if that happens, the next push won't feel comfortable. It never does. It will feel noisy. It will feel unfair. It will feel like you're late, even if you aren't. And that's where the real pressure starts. And if those things don't stay true, if the curve relaxes, if key levels fail, if physical tightness eases, if macro turns, and then the awe shock becomes what shocks often become in silver, a violent overshoot that resets lower before the next attempt. Both are possible. That's why you don't marry one outcome. One last thing before we close, because it's the subtle CTA that actually matters. If you're still here, you're not looking for a pep talk. You're looking for mechanisms. You're looking for signals you can test. You are looking for a community that doesn't get hypnotized by headlines and doesn't crumble on the first red candle. That's the edge. Staying rational when the tape is designed to make you emotional. So this week, don't just watch the number. Watch what the number forces people to do. Watch the open behavior. Watch the curve. Watch the reaction to volatility policy. Watch whether dips are being defended or merely bouncing. Because if the market holds that mid-80s zone and keeps acting tight underneath, the odds shift toward continuation, and the risk is not missing the top. It's underestimating how far forced behavior can carry price in a stressed structure. And if instead the market fails and breaks the key zones with no reclaim, that's information too. It tells you the pressure released. It tells you the structure needs to rebuild. It tells you patience is a weapon again. Either way, you're not guessing. You're observing. You're measuring. You're staying ahead of the emotional traps. And in a silver tape like this, that's what separates the people who survive from the people who become liquidity.